Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Eos Energy, the zinc-based battery company, reporting 445% revenue growth as Z3 hits commercial scale.
Eos Energy was founded in 2008 in New Jersey to commercialize zinc-based storage, a non-lithium chemistry designed for multi-hour grid applications, where lithium-ion falls short economically.
Eos listed on NASDAQ in 2020 via SPAC merger. The company spent years proving the Z3 chemistry at pilot scale before securing a $398.6 million DOE loan to fund full manufacturing scale-up.
Joe Mastrangelo has served as CEO since 2020. He joined from GE Power's gas turbine business, bringing large-scale manufacturing experience to a company scaling to gigawatt-hour production.
Most recently, Eos reported revenue of $57 million, up 445%. Full-year guidance of $300 to $400 million reflects a sustained manufacturing ramp as deployments accelerate.
The revenue surge is Z3 system deliveries to utility and commercial customers. Each deployment generates upfront revenue and a services tail, creating multi-quarter backlog visibility.
Eos's core moat is chemistry. The zinc hybrid Z3 is non-flammable, uses domestic materials, and targets 4 to 12-hour storage, where lithium-ion faces cost and safety disadvantages.
The DOE loan is a structural moat. The $398.6 million federal facility lets Eos scale without equity dilution that crushes early hardware companies, an advantage competitors cannot replicate.
The long-run thesis is grid storage displacement. As utilities retire fossil fuel peakers, they need multi-hour storage, a requirement lithium-ion cannot address economically at scale.
Against Fluence and ESS Tech, Eos competes on chemistry safety, supply chain, and duration. Fluence has broader utility relationships, but Eos's zinc platform serves duration gaps lithium cannot fill.
U.S. grid storage demand is accelerating. IRA incentives, renewable intermittency requirements, and utility mandates are driving multi-year procurement pipelines independent of spot energy prices.
The near-term challenge is gross margin. Eos is moving from negative to positive margins as factory utilization ramps until throughput reaches steady state. Unit economics lag the target.
Execution risk is the primary concern. Hardware scale-ups face yield issues, supply chain disruptions, and installation delays, any of which can push revenue significantly below guidance.
Policy risk is secondary. IRA domestic content requirements and storage investment tax credits are critical to customer economics. Clean energy policy rollback would directly impact Eos's backlog.
The manufacturing learning curve is the medium-term margin catalyst. As the New Jersey facility reaches planned throughput, cost per kilowatt-hour should decline toward lithium-ion parity.
International expansion is option value. As domestic deployments build a reference base, European and Asian grid operators facing similar duration gaps become addressable markets.
At $2.6 billion in market cap with $300 to $400 million in revenue guidance and a DOE-funded ramp, Eos is priced for a successful scale-up. A bet zinc chemistry reaches cost parity faster than expected.
Eos Energy just reported 445% revenue growth. Zinc-based storage is reaching commercial scale at the exact moment the grid needs it most.
Let's get into the Z3 manufacturing ramp and what the utility-scale storage opportunity means for the revenue guide.
Zinc chemistry, grid storage, and a DOE-backed ramp, Eos is building the battery that fills the gap where lithium-ion falls short. Now let's get into the numbers.
Eos Energy grew revenue 445% in Q1. That is not a typo. $57 million in battery sales, up from about $10 million a year ago. GAAP earnings of 12 cents per share beat estimates of negative 22 cents. The catch, the 12 cents is largely from IRA tax credits, not from selling batteries at a profit. Gross margin is negative 78%. The AMPC credit is the bridge. The question is whether it holds.
Welcome to Charged Alpha. I'm Lana, here with Hudson. Today we're breaking down Eos Energy's Q1 2026, the zinc battery long-duration storage company that posted one of the most dramatic revenue growth rates in clean energy this quarter, while simultaneously revealing how much of that reported profit depends on federal clean energy policy staying intact.
Quick orientation. Eos Energy, ticker EOSE, is headquartered in Edison, New Jersey, founded in 2008 with approximately 360 employees. The company manufactures zinc-based long-duration energy storage systems from its Turtle Creek, Pennsylvania facility. Eos is an early commercial stage company. It has real revenue from real battery shipments, but gross margins remain deeply negative as manufacturing scales.
The core product is the Z3 battery system, designed for 3 to 12-hour storage durations. Unlike lithium-ion batteries optimized for 2 to 4 hours, zinc chemistry is cost-effective at longer storage durations needed for grid balancing, renewable integration, and peak shaving. The primary customers are utilities and independent power producers that need to store solar and wind generation beyond what lithium-ion systems can economically provide. The U.S. utility-scale storage market is projected to grow from 15 gigawatt-hours annually to over 80 by 2030.
The Inflation Reduction Act's Advanced Manufacturing Production Credit is the critical policy mechanism for Eos. The AMPC provides a per-kilowatt-hour manufacturing incentive for domestically produced battery systems. For Eos, this means that every Z3 battery manufactured at Turtle Creek earns a federal tax credit that at current scale more than offsets the negative gross margin on each unit shipped. The AMPC credit turned Q1 EPS positive, and its continuation is essential to the path to profitability.
Q1 2026 revenue was $57 million, up 445% from approximately $10.5 million in Q1 2025. The consensus estimate was $40 million. Eos beat by 43%. The revenue growth reflects the Z3 battery manufacturing ramp at Turtle Creek as the company transitions from prototype scale to commercial scale production. Several utility customers took delivery of Z3 systems in Q1 following project award announcements in late 2025.
GAAP EPS came in at positive 12 cents per diluted share, beating the negative 22-cent consensus by 34 cents. That headline beat requires a full explanation. The 12 cents positive figure includes recognition of approximately $25 to $30 million of IRA Advanced Manufacturing Production Credits earned on Z3 batteries shipped in the quarter. Without those credits, the GAAP EPS would still be deeply negative. The credits are turning an otherwise loss-making operation into a reported profit on paper.
Gross margin was negative 78%. For every dollar of Z3 batteries Eos shipped, it cost $1.78 to manufacture them at current scale. That is not a rounding error. It reflects the reality of an early-stage manufacturing business where the cost of materials, labor, and facility overhead has not yet been absorbed by sufficient production volume. Every unit shipped destroys cash on the manufacturing margin line before the AMPC credit is applied.
The AMPC credit changes that math substantially. The Inflation Reduction Act's manufacturing incentive is designed precisely to bridge companies like Eos from negative margins to positive unit economics while they scale. The credit applies per kilowatt-hour manufactured, and as Eos ships more batteries, the total credit amount grows proportionally. Management's roadmap assumes that the combination of AMPC credits and manufacturing cost reductions will bring gross margin to positive territory within 18 to 24 months.
Operating cash flow for Q1 was negative $12 million. Despite the reported GAAP profit, operating cash burn reflects ongoing facility costs, working capital requirements, and the timing difference between manufacturing investment and customer payment. The company has approximately $150 million in cash against $300 million in debt, a tighter balance sheet than ideal, and one that creates pressure to execute the cost reduction roadmap on schedule.
The revenue trajectory is the most important forward indicator. At $57 million in Q1 and a manufacturing capacity that is ramping at Turtle Creek, full-year FY 2026 revenue guidance suggests $350 million or more, a trajectory that requires continued delivery execution across multiple utility customer projects simultaneously. The ability to deliver on that revenue guide without significant manufacturing delays is the near-term operational test that will determine the credibility of the cost reduction roadmap.
CEO Joe Mastrangelo joined Eos in 2020 from GE Power, where he ran the gas power business. His background in large industrial manufacturing is directly relevant to the challenge of scaling a battery factory from prototype to commercial production. On the Q1 call, Mastrangelo emphasized that the Turtle Creek facility is tracking on schedule for manufacturing automation milestones that are central to the cost reduction roadmap, and that the AMPC credit provides the necessary bridge.
Wall Street's coverage of Eos Energy is thin and cautious, with 2 buys, 5 holds, and 1 sell at an average price target of $5 against the current price near $4.50. The holds and the sell reflect skepticism about whether the AMPC-dependent beat represents a sustainable unit economics improvement or a policy-contingent accounting benefit that disappears if IRA provisions are rolled back.
Goldman's neutral is a show-me stance on the gross margin roadmap. The negative 78% gross margin requires a very large reduction to reach positive territory, and the combination of manufacturing automation milestones plus continued AMPC policy creates 2 contingencies that Goldman says do not justify an upgrade at current prices.
Piper Sandler's neutral is similarly execution-focused. 445% revenue growth is extraordinary, but the question is whether Eos can manufacture at scale without the disruptions that have plagued early battery makers, failed shipments, quality failures, and project delays in a market where utilities have alternative storage suppliers.
The 2 buy ratings share a common thesis. If IRA policy holds and the manufacturing ramp executes, Eos reaches positive gross margins in 2027 when grid-scale storage is the fastest-growing clean energy segment. The long-duration advantage of zinc at 4 to 12-hour durations is real technical differentiation that matters as grids become more renewable-heavy.
The sell rating reflects balance sheet fragility. $150 million in cash against $300 million in debt, with negative operating cash flow, creates a tight runway. Any manufacturing disruption, quality failure, supply chain issue, or project cancellation would force an equity raise from a position of weakness at highly dilutive terms.
The bull case starts with the AMPC credit scaling as production scales. As Eos ships more Z3 batteries, the total AMPC credit earned grows proportionally with kilowatt-hours manufactured. If the manufacturing ramp hits management's targets for 2026 and 2027, the AMPC credit alone could generate enough cash to fund operations and eliminate the need for additional equity dilution, turning the tax credit into an effectively free source of capital that sustains the business until intrinsic unit economics improve.
The long-duration storage market is becoming structurally larger with every renewable energy project commissioned. As more solar and wind capacity is added to the grid, the need for 4 to 12-hour storage to balance intermittent generation grows proportionally. Lithium-ion is cost-effective at 2 to 4 hours. For longer durations, zinc and flow battery technologies have a fundamental economic advantage that will become more pronounced as utilities design storage systems for the renewable heavy grids of the late 2020s.
The bear case starts with policy risk that cannot be hedged. The AMPC credit that turned Q1 EPS positive is a federal program that requires congressional action to maintain. Any rollback, reduction, or sunsetting of IRA clean energy manufacturing provisions would immediately eliminate the primary driver of reported profitability and force Eos to compete on intrinsic unit economics that are currently deeply negative. The company's survival in the medium term depends on policy that is politically contested.
The negative 78% gross margin represents an enormous engineering challenge. To reach positive gross margins at scale, Eos must reduce manufacturing costs by 60% or more, while simultaneously scaling production volume by 5 to 10 times. These 2 things are not independent. The automation investments required to reduce cost require capital that the current balance sheet cannot easily support, and the timing risk of getting both simultaneously right is high.
LFP lithium iron phosphate battery prices falling faster than expected is the competitive risk below. LFP prices have dropped 80% over 5 years and continue to fall. If LFP achieves cost parity with zinc at 4 to 6 hour storage durations before Eos achieves positive gross margins at current pricing, the window for zinc chemistry to establish a cost-competitive position narrows considerably, and Eos's entire commercial strategy depends on that window staying open long enough to reach scale.
EOS Energy options activity is thin given the smaller market cap and the penny stock adjacent price range, but the Q1 beat generated call buying at the $5 to $6 strikes for the August expiration. The put-call ratio of approximately 0.9 reflects a roughly balanced market view. Buyers who see the AMPC credit as a sustainable bridge to profitability versus sellers who view the negative gross margin as the structural reality that policy benefits cannot permanently fix.
Implied volatility is very high, as expected for a small-cap early commercial manufacturing company with policy risk, balance sheet risk, and execution risk all simultaneously elevated. The IV profile creates option strategies that are attractive for investors who want to take a position on the binary outcome but cannot stomach the common equity volatility. Long-dated call options at modest strikes are the most common institutional structure for this type of risk profile.
CEO Joe Mastrangelo has maintained his equity position without selling. Board discussions about strategic utility partnerships have been referenced without specific announcements, suggesting either conversations are ongoing or the company prefers to reach manufacturing scale before negotiating from a position of demonstrated execution rather than promise.
The primary catalyst for EOS is a Q2 or Q3 delivery milestone that demonstrates consistent commercial-scale manufacturing without quality or delivery disruptions. If EOS ships $60 to $75 million in Q2 with positive customer references and no delivery failures, it builds the operational credibility that would justify analyst upgrades and a re-rating of the multiple toward revenue-based valuation frameworks, rather than the current fundamental skepticism about execution.
A major utility anchor contract, a multi-year gigawatt-hour scale offtake agreement, would be transformative. Such a contract provides revenue visibility, negotiating leverage for supply chain financing, and signals that a sophisticated buyer independently validated EOS's product quality through their own technical diligence.
The key risks are IRA AMPC rollback, eliminating the primary profit driver, gross margin improvement falling behind schedule and forcing a dilutive equity raise, and LFP cost deflation closing the window before zinc chemistry reaches competitiveness. Any combination of these risks would call into question the business model without a major restructuring.
That's the EOS Energy Q1 2026 breakdown. 445% revenue growth to $57 million. A 34-cent GAAP EPS beat driven by IRA manufacturing credits. Negative 78% gross margin that those credits are designed to bridge. The long-duration storage market is real and growing. Whether EOS survives long enough to capture it depends on policy stability and manufacturing execution happening simultaneously. Subscribe to Charged Alpha to track both.
Charged Alpha content is for educational and entertainment purposes only. Nothing you hear on this show should be taken as financial advice. We do not hold positions in the securities discussed unless explicitly stated. Always do your own research and consult a qualified financial advisor before making any investment decisions. This is Charged Alpha. We charge forward, so you stay informed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.